Factors are the foundations of investing. Factors define the broad drivers of returns across asset classes. Knowing the factors that drive returns in your portfolio can help you choose the right mix of assets and strategies for your needs. Investing in factors can improve portfolio outcomes, reduce volatility, and enhance diversification. To throw more light on the subject for our viewers, we have with us today Mr. Umesh Kumar Daila, Head ETF Sales, Mirae Asset Investment Managers Private Limited, and I am Sutit Sanyal, your host for the evening. Welcome, Mr. Daila. To start with, could you help our viewers understand factor investing strategy?
Yeah, thank you, Mr. Sanyal, for having me on the show. So yeah, actually, so we have been historically invested in a broad-based kind of market, broad-based kind of strategies where the investment generally happens in, say, broader markets. So when we talk about factor investing, this is basically, it is an investment strategy where basically stocks are selected based on, well-researched attributes. Those attributes help in terms of driving growth in stock or returns in stocks. For example, selecting a stock based on lesser volatility or lesser risk is considered as investment in low volatility as a factor. So this is basically putting some different, filters or different factors while choosing a specific investment style. Different styles. There are multiple factors which are being used globally. In India, few of them has already introduced, like you can talk about low volatility factor, or a quality factor, or a equal-weighing factor, right? Or for that matter, momentum factor. So as I said, every factor has a different way of selecting stocks depending upon different market cycles. So it is I must say, in one step further, the way of investing, which we have been investing historically, it is a one step further from there, where we are putting specific factors to the market while selecting a stock.
So if we can say, so where does factor investing stand if we compare it to the two popular investment strategies, that is active and passive?
Yeah, so smart beta is, as I said, smart beta is a rule-based investment strategy that combines some of the principles of active management, which is like, say, factors used in stock selection, right, with a passive approach. So it is a combination of active and passive, where the stock selection happens the way active stock selection does, but in a passive way. By combining characteristics of both active and passive, smart beta strategies basically allows investors to retain many benefits of passive investment, be it a cost, be it some other ways of investing, and seeking outperformance, or I must say potential outperformance from an underlying index, because the investment in such a way. The selection of stocks is done by using factors like, as I said earlier, also low volatility, quality, equal weight, momentum, etc., which have worked well also historically. And we feel that the way markets are growing, these kind of strategies are going to play a more important role.
Now, as a concept, this is very new in India, but how successful is this model in other countries, as in and abroad?
So, I mean, globally, if I talk about, say, I would like to put some data points here, which I've taken from ETFGI. The data is as on February 28, 2023. If we look at globally, there are close to 1,280 smart beta ETFs already listed, right? The listing is around 2,655, because one ETF is listed in different markets, so the number of listing is higher. So 1,280 smart beta products listed, around 2,655 number of listings. The total AUM is around $1.28 trillion, right? Which is basically, there are 201 ETF providers who have launched such products, or asset managers who have launched such products, which are listed into, you can say, 49 exchanges globally, which is like close to 38 or 39 countries, right? So smart beta ETF, like if you talk about 2023 also, the smart beta ETF has now witnessed a more than kind of $8.3 billion of inflows in last 2 months of 2023. And that if the trend continues, which we feel that it is going to be continued, so we can see that this will be, if we include only February also, this will be the 31st month of consecutive net inflows of smart beta ETFs globally. So this is a very, very well accepted concept globally, which I'm sure the data is already showing off.
So in a country like India, I mean, there's always a scope for a fund manager to generate alpha. So what's the benefit of factor investing?
So actually, as I said, though smart beta is funds are not actively managed, so they are typically, I must say, not actively managed. Alternatively, the way the weight has been constructed, they may provide some frequent fund analysis, rebalancing than traditional index fund, because the stock selection happens that way. So that's why it's a combination of active and passive, right? And it giving you potential to outperform market in sometimes, because if you look at, say, if you choose a specific theme, like say, or a specific factor, say low volatility, and the markets are, like, say, you can say turbulent in terms of not one-sided, or some recessionary issues are there, or we can see the markets are not stagnant. In those scenarios, low volatility kind of factors might play well. And in that case, if for an investor perspective, though India is, it's still a alpha driven market, we still believe that the active funds have been doing well in pockets. But from an investor perspective, completing a portfolio at an investor level, these kind of factors are playing a very important role.
Okay, so I will come to the next question. As you said, this is a completely very new concept in India. So suppose if investors were to, I mean, thinking of investing, what should they keep in mind while opting for factor-based investment?
So, because smart beta, factors are basically, they are based on the preset rules, which are already determined. The process for, security selection, portfolio construction, and maybe rebalancing also. So the rules are not adjusted for changing market environment. The rules are going to be same for across market cycles. So investors have to keep in mind which sort of factor he or she is looking for, and what is the view he or she has on the market going ahead, whether they are taking a short-term call or they are looking for a long-term perspective. They can look for such product, because when we talk about factor investing, they try to improve return also, but simultaneously they give you good diversification also. So while exposure into certain factors has been historically rewarded, which the historical data has been showing, but I must say investors should always look at which market cycle he is bullish on, what he or she feels that going ahead, how the market is going to behave. Accordingly, the factors can be chosen for his or her portfolio.
All right. So in that context, so how can an investor decide on factor investing while uh, building a portfolio? As you know, and in different factors follow different approach, such as lower valuation, high beta, and so on and so forth.
Yeah. So basically, for that matter, any investment which is in, be it in through active or passive or any factor or any broad-based market-based also, every fund, every investment comes with a certain kind of risk profiling, and investor should be matching with that risk profile. Then only investor should look at. When I talk about smart beta investing, it is basically, you can say, it provides a systematic risk-adjusted return premium also, and every factor has a different kind of risk appetite, and investors should look for that. Like as I said, if markets are on a bull phase, then in that scenario, momentum factors might do well, because that markets are going upside and the investor is bullish. Then these kind of factors can help, where the selection will be on based of stocks which are showing higher momentum than the rest of the market. Similarly, on a downside market or on a volatile market, turbulent market, the stocks investor can look for a low volatility factor, which gives the exposure to investor to those companies which are lesser volatile in the turbulent market timing. So these kind of products gives investor different kind of risk. So investor has to look at which sort of risk profiling he is looking at, or he or she is comfortable with that. Because like as I said, low volatility, momentum, there are other factors also like quality, like your equal weighing. So investors should be well aware of every kind of risk of underlying factors, and then accordingly investors should look at the investment decision to be made.
So in the Indian context, who have been the typical investors? I mean, more of a retail side or the institutional or the HNIs?
So again, I would like to put some data point here. If I go by MFI data, which is published on as on 28th February 2023 and as on 31st December 2022 for accounts, I think if I talk about since December 2014, there is a steady increase in you can say investor accounts across mutual fund industry, which is like from 4.03 crore to 14.11 crore, sorry. So in December 2022, this number is 14.11 crore. There has been a tremendous growth in terms of across categories in mutual fund, and similar kind of growth we have started seeing in ETF as well as in the FOF segment also. Like if we talk about from an asset or from an AUM perspective, I will say 90% of the AUM is being captured or led by institutional or HNI investors. But when I talk about number of accounts, close to 98% folios belongs to retail investors, and I believe that similar kind of trend we can see in factor investing also going ahead.
What should be the ideal portfolio allocation?
Yeah, so that's a very important question, I must say, because I would say based on the investor's investment objective, investor's goal, right? Investor can take a call while investing into different factors. The call can be short-term in nature also. If investor has a very short-term view in a specific factor, he or she believes that this is the market cycle is going to behave like this for a short-term period. Investor can very well take short-term calls also with these kind of factors, and also investor has a long-term view on a specific sector or market cycle, investor can take a long-term call also. So factor investing gives you exposure or gives you freedom to look for both the sides, both the options, short term as well as long term, and investor can complete the portfolio depending upon his or her risk profile, and also depending on what sort of portfolio investor is already holding and what are the missings in the portfolio, where investor can add on these factors which can give some kicker to the overall return of the investor's portfolio and some kind of stability also, because if the factor is chosen at the right time, at a right market cycle, it always gives benefit or helps the overall portfolio of the investor.
Viewers, with that, we come to another episode of our webinar. Thank you, Mr. Daila, for throwing light on factor investing. I'm sure our viewers would have benefited from this immensely. We look forward to you again in our next episode. Thank you.
Thank you. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.